Today, we will talk about financial literacy, enhancing knowledge about finance. So before we get started, make sure to hit that like button, also subscribe to my channel. Financial literacy is the ability to understand and effectively use various financial skills, including personal financial management, budgeting, and investing. When you are financially literate, you have the foundation of a relationship with money, and it is a lifelong journey of learning. The earlier you start, the better off you will be, because education is the key to success when it comes to money. Understanding financial literacy. From about 2000 to 2022, financial products and services have become increasingly widespread throughout society. Whereas earlier generations of U.S. residents may have purchased goods primarily in cash, various credit products are popular today, such as credit and debit cards and electronic transfers. A 2021 survey by the Federal Reserve Bank of San Francisco revealed that 28% of all payments were via credit card, with only 20% being made in cash. Given the importance of finance in modern society, lacking financial literacy can be very damaging to an individual's long-term financial success. Scope of financial literacy. Although many skills might fall under the umbrella of financial literacy, popular examples include household budgeting, learning how to manage and pay off debts, and evaluating the trade-offs between different credit and investment products. These skills often require at least a working knowledge of key financial concepts, such as compound interest and the time value of money. Other products, such as mortgages, student loans, health insurance, and self-directed investment accounts, have also grown in importance. This has made it even more imperative for individuals to understand how to use them responsibly. Financial literacy can cover short-term financial strategy, as well as long-term financial strategy, and which strategy you take will depend on several factors, such as your age, time horizon, and risk tolerance. Financial literacy encompasses knowing how investment decisions made today will impact your tax liabilities in the future. Create a budget. Track how much money you receive each month against how much you spend on an Excel sheet, on paper, or with a budgeting app. Your budget should include income, paychecks, investments, alimony, fixed expenses, rent mortgage payments, utilities, loan payments, discretionary spending, non-essentials such as eating out, shopping and travel, and savings. Pay yourself first. To build savings, this reverse budgeting strategy involves choosing a savings goal, such as paying for higher education, deciding how much you want to contribute toward it each month, and setting that amount aside before you divvy up the rest of your expenses. Pay bills promptly. Stay on top of monthly bills, making sure that payments consistently arrive on time. Consider taking advantage of automatic debits from a checking account or bill pay apps, and sign up for payment reminders by email, phone, or text. Get your credit report. Once a year, consumers can request a free credit report from the 3 major credit bureaus, Equifax, Experian, and TransUnion, through the Federally. Review these reports and dispute any errors by informing the credit bureau of inaccuracies. Because you can get 3 of them, consider spacing out your requests throughout the year to monitor yourself regularly. Check your credit score. Having a good credit score helps you obtain the best interest rates on loans and credit cards, among other benefits. Monitor your score via a free credit monitoring service, or if you can afford to and want to add an extra layer of protection for your information, use one of the best credit monitoring services. In addition, be aware of the financial decisions that can raise or lower your scores, such as credit inquiries and credit utilization ratios. Manage debt. Use your budget to stay on top of debt by reducing spending and increasing repayment. Develop a debt reduction plan, such as paying down the loan with the highest interest rate first. If your debt is excessive, contact lenders to renegotiate repayment, consolidate loans, or find a debt counseling program. Invest in your future. If your employer offers a 401 retirement savings account, be sure to sign up and contribute the maximum to receive the employer match. Consider opening an individual retirement account (IRA) and creating a diversified investment portfolio of stocks, fixed income, and commodities. If necessary, seek financial advice from professional advisors to help you determine how much money you will need to retire comfortably and develop strategies to reach your goal. Example of financial literacy. Emma is a high school teacher who tries to inform her students about financial literacy through her curriculum. She educates them on the basics of a variety of financial topics, such as personal budgeting, debt management, education and retirement saving, insurance investing, and even tax planning. Emma's students can and will use these concepts later in life for things like renting an apartment, getting a first job, or even just paying for fun activities such as going to the movies. Understanding concepts such as interest rates, opportunity costs, debt management, compound interest, and budgeting, for example, could help her students manage the student loans that they might rely on to fund their college education and keep them from amassing dangerous levels of debt and endangering their credit scores. Why is financial literacy important? Being financially literate from a young age gives an individual the tools and resources they need to be financially secure later in life. The lack of financial literacy can lead to a number of pitfalls, such as accumulating unsustainable debt burdens, either through poor spending decisions or a lack of long-term preparation. This, in turn, can lead to poor credit, bankruptcy, housing foreclosure, or other negative consequences. What are some popular personal budget rules? Two commonly used personal budgeting methods are the 50-20-30 and 70-20-10 rules, and their simplicity is what makes them popular. The former entails dividing your after-tax, take-home income pay into three areas: needs 50%, savings 20%, and wants 30%. The 70-20-10 rule also follows a similar blueprint, recommending that your after-tax, take-home income be divided into segments that cater to expenses 70%, savings or reducing debt 20%, and investments and charitable donations 10%. What do you think about our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.